All right. So those of you who don't know me, my name is Sid. I run an investment firm based on multifamily apartment complexes, commercial real estate. Today's topic for our monthly webinar is kind of curated for people who have asked me questions in past. You know, hey, what is after investing, and what are the benefits that we can unlock by smartening up our tax strategy. So before we go any further, I just want to make sure you guys have our phone number. If you want this slide, we will send you a recording. Even if you're unable to join tonight, you will get a recording tomorrow or Friday. But if you want to note down this number, and if you text us, either Farah or Camilla, who is a part of our team, they will send you those slides. It's 281-559-7061. You can call and text, and one of our team member will help you with that. So a quick disclaimer. We bring these webinar once a month, and this is just our effort to add value um, to our audience, to people who have been, working with us or wanting to work with us. And by no means, we are not a CPA, we're not financial advisors. We do not charge you for any advices. We actually cannot do that. So for that reason, all of this information that we're going to share or trying to educate ourselves tonight in this webinar is purely from our perspective, what we have learned over the last 15 and 16 years while doing this business. So um, before I can formally introduce myself and my team, I believe in letting you know why this webinar I think is important for a webinar for our audience. So next few slides, maybe 10 to 15 slides, I'm going to go very quickly, and I'm just going to touch some fun facts, right? We're going to talk about who is this webinar is for. We're going to talk about why is it important, why is it not important, right? And hopefully by end of these next 2 to 3 or 5 slides, you will know whether this is for you or not. So this webinar is specially designed for our investors or our prospective investors who are either engineers, IT professionals, physicians, AI professionals, business owners, people who are in medical field and own practices, people who are simply just investment focused and want to learn anything and everything about commercial real estate investment. And on a lighter note, if you are like me, whoever refer IRS codes as tax loopholes, I would encourage you to stick around and see what is my reason not to stop calling tax loopholes and actually referring you to correct IRS codes. What I mean by that is we as professionals are so busy in our own profession that we do not have time to knowing the actual available allowed flexibility that IRS provides us when it comes to real estate investments or tax saving or tax strategies. So this is also a webinar for somebody or family whose household income is $200,000 more. Did you know that you're making, if your household income is 200,000 or more before taxes, really not net, you're an ideal customer for IRS. IRS is actually looking for you. And if you are making that $200,000 as a family of 2 or 4 or 5 and maintaining a certain lifestyle, really you need, at the time of your retirement or getting close to your retirement or right after retirement, you need $5 million to be able to afford that kind of lifestyle. And that based on the 4% method. If you're not aware of the 4% method, it's simply how in financial market, people refer it as 4% annuities. That is considered to be the safest investment out there. It's not a stock exchange. It's not a Bitcoin. It's just 4% annuity. It's really just a bond paper, right? It's the most secure US bond paper that gives you 4%. By the way, that 4% has not been the case. It's been much lower for the last few years. Point I'm trying to make, if you are on this webinar, just know if you're making 200,000 or more, you're the ideal candidate for IRS. You're the ideal customer for the IRS, an ideal candidate for the IRS to come after you for all the taxes. If you are on this webinar and you feel like you're not being fairly compensated, right? Or you feel like you're working too much and you are at a point of burnout, well, stick around. We'll talk more about that. Did you know, right? There's one other interesting fact and fun fact that most, if not all, of the religious organizations in the United States are exempt of filing federal tax. Well, how is that related to us? It's not. But the point I'm trying to make is there's so much out there, so many ways, so many um, allowed IRS laws that other organizations, other people um, avail it, right? So one of the great example is that all of these religious organizations, it could be church, could be synagogue, could be mosque, could be temple, they are exempt from filing federal tax. I didn't know that. I got it. I just found out about a few years ago. You also know that the top middle class American family, to maintain a lifestyle what they maintain, they can only survive up 4 months if they lose their job today. So that's to me, when I heard that statistic, I was shocked. So I just wanted to share with you guys. You guys know that a normal business, say if you're running a business, a normal, good, healthy business will produce to 30%, 35%, sometimes 40% return. 40% to 50% is on the higher side. But on the real estate side, if all benefits accumulated, the returns that you get from the real estate, depreciation, the appreciation of the asset, the depreciation of the tax, it can very well cross 400% of your return. Now, this is a big number, and that's exactly why we are today here to kind of see why is that a big difference and why some people are able to get those big returns versus others not. You also, we all know, right? Real estate is it's an asset-backed investment opportunity. And it's when all overall real estate always outperform or outweigh any other volatile investments, whether it's a Bitcoin or it's stock investment, right? I'm not against stock investment. I also have some portfolio in stocks, but I've done it both. And year over year, I realize my real estate investments or my investors' real estate investments are in much better position than the stock investments, only because of the volatility. This is just so much prone to what's going on in the market, what's going on in the politics. Not that real estate is not, but it's still an asset-based investment that has the back of actual commercial real estate. Is one of those when we are doing our investments, one of the big thing that is close to us is knowing why we're doing that. Right? If you are just like most people around, right? If you really want to give back, did you know that you can actually take loan to give back into charity and get the tax break? So once again, these are all the fun facts that I like to share. And if these are the things that you didn't know, you want to stick around towards the end of the webinar. Do you know that most people, rightly so, are very much risk averse? I mean, we always pay premium to avoid risk, but most people may not realize or agree that just relying on just one W-2 is also a risk. How many of you think you are paying too much income tax? And I can tell you every day, all day, anytime when I ask this question in the audience, I see everybody raising their hands, including myself, right? Even though I've worked my way up to get to a point where I pay very little or no income tax. But if you are one of those people who really think that you're paying too much income tax, you want to stick around and come get to the end of this webinar. Do you know that the educated investor pay extremely low or no income tax, and a lot of times they die without paying any tax if they are doing it correctly. Now, I'm referring to I'm using the word educated investors. I'm not saying in smart. I'm not saying wealthy. I'm not saying a tech investor or any kind of other investor. Right? The goal for these webinars once a month when we do it, all we try to do is try to share our knowledge, hopefully gain the knowledge along the way, and hopefully present it to you guys where you can start your journey somewhere, right?
Sorry, Sid, to cut you off. There's a request if you can come closer to the mic.
Right. How about now?
I think that's good.
Let's see. So going back, if you look around, people who have been in investment domain for some time, you will learn that they are in a tax bracket that is the lowest out there. In most cases, they don't even pay any taxes. If you want to know how, this is why we are here to do this webinar. Another way to look at it, if you take some actions And by not adding any extra hours, or maybe in some cases working less, yet increase your income by 30%, well, the only way to do it is to reduce your taxes or reduce your tax burden or defer your tax burden or strategize in a way that you never have to do it. To me, that's the smartest way to increase your income without taking any additional risk or any additional putting additional hours. I want to do a quick mic check again for, is that good?
Yeah, I think that's a thumbs up.
Right.
That's good, right? Great.
So the good news is, right, these are all the strategies out there. They're not difficult. They're super easy, but they're really hard to implement. The news is that's not going to happen overnight. I see my example and likes of me who started 10, 15 years ago. I'm not saying it's going to take that much time to you guys. I really think if you plan it accordingly and if you do the right things at the right time, it may take 3 to 4 years for you to get there where you actually pay as minimum tax as possible by following IRS codes. So if you're still with us, right, I want to introduce me and my team. We have Farah and Camilla on our webinar. Once again, my name is Sid. I'm the founder. We started this company with one goal that we wanted to invest in real estate. We started really small, and 15 years down the line, now we are the biggest investor in all of our investment. Mama is my wife. Helps. She's also for an affiliation, but she's also look after a few important decisions, as you can tell. Brandon Farrow, he's a restoration director. Brian is on sabbatical right now. He's a small baby. We really are happy and excited for him. Omar Nakri is our chief financial officer. He's an investment officer, and he looks after all of our investment performance and day-to-day financials and numbers. Today, we manage somewhere around 550 million assets under management. We have about 3,300 units under management, meaning apartment complexes. Our target every return, whenever we try to buy a property, is anywhere between 25 to 30%. And we have about 430 active investors as of today. This is the most boring slide, but I always try to throw it in. Internally, whenever we talk within a team, I always say, and I was told, and this is our philosophy, a not so smart person who is super focused, who's disciplined and consistent, can perform and outperform anybody who's smart and distracted. So this is our flywheel. Whatever we do, we have a philosophy of staying focused, inch wide, mile deep. And if somebody can tell us that, hey, you guys are disciplined and consistent, that's boring, but I love this compliment, right? This is the most boring compliment that I can learn. Our philosophy is to do what we love to do. We live fully and we give back. Hopefully, when we are departing this, when you're leaving this world, we don't left anything to give. So that's our goal. Agenda today, for all of these fun facts, my goal is to, in next 40 minutes or so, if we can get just 1% smarter with our respective income and tax situation with real estate, I think we can. I think I can call this as a success, right? It's a 40 minutes presentation, and I can tell you that if you grab 20-25% of what I'm going to talk about, I'm going to go a little faster than usual because there's a lot to unpack here. But if you can get 20% of it, that's a great start. And I hope by end of it, you may be able to take some action, talk to your consultants, talk to your CPAs, talk to your spouse, and may be able to plan something for next year or year after, and hopefully get to a smarter future. So we'll talk about, but in order to get to this point of just becoming 1% smarter, I'm just going to go over some key concepts. What is real estate depreciation? How depreciation or a real estate depreciation reduce your taxable income? What is cost segregation? What is bonus depreciation? What happens when you sell an asset? How do you handle the capital gain? How can you manage that? And then more importantly, what is the rep status? How refinance supercharge your wealth? And then we're going to talk about the most common 4 combination of tax situation or income/tax situation that can be out there, right? And those are somebody who's just a W-2, somebody who's married, and the spouse, husband and wife and spouse are both W-2, or there could be a scenario where one person is W-2, the other person is a homemaker, I call them home CFO, right? Because they are chief financial officer of the household, or somebody, or there could be a scenario where one spouse is a W-2 and the other one is a business owner. And the last could be, yeah, right, both business owners. There are some other scenarios as well where, both of the spouses are just retired and they're just enjoying their life, right? In all of these cases, what I will try to do is try to go over some key concepts really fast and try to go back into how this can help you and what other actions can you take, right? So let's talk about what is depreciation. In simple words, when you buy something, it's especially a physical asset. Theoretically, that asset value goes down because the physical asset depreciates every single year. In an accounting world or an IRS world, it's a non-cash expense, right? So it's called paper depreciation. So in other words, say if you bought a house, every year your structure of the house, the value of the structure of the house will go down, and the land will go up. So the land value always go up every year, but the actual physical property depreciates down. Well, you might ask, like, why is the case where county come back and increase our property tax? Well, because in reality, in practical terms, the value actually going up, right? So county comes back to you and say, hey, where you live, the subdivision where you live, all of the other houses in your subdivision going up in the value. So now you have to pay more taxes. But as far as the accounting and the IRS world are concerned, if some of you are CPA, you know what I'm talking about. The actual value depreciates, right? So IRS recognized that the building wears and tears. The annual deduction lower your taxable income. So, for example, you bought an ownership in a commercial real estate. That property depreciates. It gives you the cash flow, and a lot of times that cash flow, actually most of the time, those cash flow is tax free because that's coming out. The net is coming out after depreciation. So, in short, that concept of physical asset, the structure is going down in the value theoretically is what depreciation is. We call several names. There's several names out of there. Non-cash expenses, paper expenses, and things of nature. My goal today is to try not to use the actual CPA terms or IRS terms. I try to use the simplest possible terms possible that I try to understand, right? So, and I'm going to make sure everybody's on my level. If somebody in the audience right now is a CPA or a financial professional, apologize in advance. We'll try to keep it simple for rest of us. So really the other distinction about in depreciation is there are two different set of depreciation. One is where I'm surprised how was somebody else said close to mic. Okay. Sorry about that, guys. One is the straight line and the other one is the bonus depreciation. So what happens is when you buy an asset, it will either depreciate as a straight line, which takes 27 and a half years, versus you can go back to IRS and you can perform a bonus. It's called accelerated depreciation, meaning you're able to take most of the depreciation in year one. In order to do that, there's something called a cost segregation study that you have to do. So in other words, what you can think of is, say you bought a commercial real estate and you realized you did a bonus depreciation, but in a commercial real estate, not everything will take 27 and a half years to depreciate. IRS allows you to go hire engineers from a cost segregation study, cost you $2,000, sometime more, and then that study tells you that what are the components that will depreciate faster. For example, if there's a commercial real estate property, the boiler or the water heater or the HVAC, that will be depreciating faster. So what's the advantage of it? Well, the things that you're going to depreciate, let's say you bought something for $10 million, it's going to take 27 and a half years to depreciate. Or in simple words, let's say you invest in a property that is $10 million and you're contributing 100,000. Well, you can take that 100,000 depreciation on year one. And we're going to see next slides how that can help you and do the magic. So let's talk about the cost segregation, right? Like I said, simply put, a team of engineers goes to the property and they try to segregate all of the items that will depreciate faster, um, and 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 go back to the IRS and say, hey, this is what we studied, and this is what it shows that how this asset can be depreciated faster. Now, recently, you guys may have heard that Donald Trump administration, they brought the 100% bonus depreciation back. Meaning, if you have an investment of 100,000, your operator, in this case us or anybody that you work with, if they do cost segregation and apply for bonus depreciation, meaning the property that the investment that you have for 100,000, there's a high chance that you might get a negative 100,000 paper losses the same year. And we'll look at it in more detail how this can actually going to help you with your tax application. So depending on the prevailing law, if you can get to a point where you have the right real estate that gives you the most appreciation, that's the start, right? So it's after you invest, how do you use that appreciation to offset your income? Keep in mind, not every single asset will qualify for those kind of depreciation, right? So rental houses, 9 out of 10 times, they do not qualify like that. What we have seen the most out there is multifamily apartment complexes, medical real estate, sometime, in very rare cases, sometime gas stations. But the problem is that the smaller you go into those real estate assets, the harder it will become to do cost segregation. So now, so far, what we just understood, right? We understood the depreciation, we understood the cost segregation, and the bonus depreciation. So there's one thing to depreciate something, but now we're going into how this depreciation going to help us, right? And how this tax can convert into an income. Say, for example, you bought a property, and your property is producing $7,000 a year in cash flow. That actual cash flow, the actual cash that came to you, let's say $7,000, that actually comes out as after $6,000 of depreciation. Meaning, the $7,000 that you received, you're actually going to pay tax on the taxable income net. There's a small typo here on the math, but instead of 10,000, right? It really should be $10,000. Instead of 10,000, you're really paying tax on $4,000. Once I send you the recording, I'll fix it and give it to you guys. Now, if you do, if you go back and you do a bonus appreciation and cost segregation, you may be able to get anywhere between 70 to 100% of your actual investment. So, for example, you found an investment and you say, "Hey, I want to invest $100,000 into this project." The first year, when you get your tax return, the first year you get your cash distribution. Let's say it's a 8% preferred. And I'll explain you what preferred means. For lack of better term, just say that your 8% is kind of guaranteed, right? Yeah, nobody will make any profit unless the investor gets 8%. But the beauty of that 100,000 investment, in addition to get this 8% return, you also get the first year tax return as $80,000 losses. Meaning, I invested 100,000. At the end of the year, I got my cash flow, but I also received $80,000 of loss. This is where everything will start, right? How do we use that $80,000 of losses, and and that loss can actually make, let's call it a paper loss, right? That 80,000 of paper loss can really offset your other income, but there are conditions applies, and this is what we're going to talk about. So in simple words, from this slide onwards, just try to remember, if you invest for 100,000, there's a high chance that you can get $80,000 of paper losses in the future. Now the question is, how do we apply that? Before we go into using that loss for 80,000, I want to make sure that we all understand and we go over this, right? That whenever you say, for example, you bought something, you have an $80,000 paper loss. In 3-5 years down the line, you sell the property. Remember, those $80,000 was a paper loss. In most cases, almost all the time, your real estate property appreciates and you sell it for more. So when you sell it for more, it has come back to you and say, "Hey, hold on a second. Claim a paper loss at the time of purchase. Now you're selling it for a profit. We want to recapture that." And we'll go into a little bit more detail in future slides. And that's where you have to plan yourself accordingly. There are several ways you can even avoid that. If you guys have heard of 1031 exchanges, that's one way of doing it. The other way of doing it is to refinance it. and I'm going to talk about it in a little bit. The third way is to do it to have enough investments where other depreciation is coming back and offsetting the capital gain of your investment. So, for example, you may have 3 or 5 or 10 investments in the course of 3-4 years, and you're selling it. You have other investments that other paper losses that's taking care of your capital gain, if that makes sense. And the third is, which is what we're not going to talk about today, and that's not my expertise, is basically estate plan. You can plan your stuff accordingly, even when you have a capital gain tax. If you do your step up estate planning with the right professional, we don't do it. We don't recommend anybody, but you can definitely go look around, and they're available. The refinance is a magical thing. Say, for example, you invest $100,000 in a project. First year, you get the $80,000 of depreciation. Year 2, you got a little bit of less depreciation because remember, you're doing an accelerated, a bonus depreciation, meaning more depreciation coming up front and less throughout the years while you're holding time. The refinance, when you try to do a refinance, and let's say you bought a property year 1 and you come to year 3, your property value went up because of the forced NOI, right? I'm not going to go into NOI. It's the net operating income, how you force NOI. It's a separate topic altogether, but that is something, if you're interested, you can send us an email. We have a different webinar and you can watch that. But for the purposes of this conversation here, the refinance happen when your value of the asset goes up. Anytime when I'm saying asset, just assume that I'm talking about commercial real estate asset. Your higher NOI, meaning higher value, and then you basically go back to the bank and say, hey, now my property value is more. I want to apply for a new loan based on a new value and give me more proceeds. In simple words, my $100,000 investment in year 3 can give me back anywhere between $25,000 to $50,000, depending on how much the value goes up. That refinance of the money coming back is a tax-free event. It's the return of your equity. That's how the IRS and the tax world understand that. So imagine you invested so far, you invested $100,000, you got the 8% preferred return for that year. Second year comes along, you get the 8% again. In the first year, you have $80,000 of paper losses, and it's a separate topic whether you can use it or not, right? Depending on your situation, and we're going to go over that in a little bit. But you also, in year 3, you receive $30,000 to $40,000, $50,000. Sometimes we have done refinances where we pulled all the cash in some of our properties. In year 3, you pull all of the cash. Now you have the property with no cash, and you did not pay any tax. Meaning, from there, every single dollar that comes to you has a much higher ROI than what you originally had. So you invested for $100,000, got the paper losses of $80,000, you got the your preferred return every year, and then year 3, for lack of to rounding up the numbers, you got the $50,000 back. So now in year 3, you're sitting with the whole property, and your money is inside. It's only for $50,000, but your share is not dropping. Remember, your share is still $100,000 a share in that property. And that's pretty powerful, right? If some of you have been doing it for some time, you know exactly what I'm talking about. And that's the key to continue increase your wealth. The last part I'm going to touch and go to the next line. If you sell, there will be scenarios where you have to sell, or you are in a good market and somebody's paying you crazy price, or you just wanted to sell and get out. The impact of capital gain needs to be offset by other paper losses coming to you. You want to think about it as a conveyor belt, as a multi conveyor belt analogy, right? Imagine you have 3, 4, 5 years. Every year you do 1 or 2 investment. After 5 years, year 6, 7, 8, these assets are being sold, but you're accumulating all those losses to offset the gains, and that's the right way to do it. We'll go more into detail a bit more. So let's talk about what is a RUC status. Remember, just a few slides back, we talked about we're going to go over depreciation, we're going to go over the bonus depreciation and cost segregation, and we're going to talk about how do we handle the recapture, right? But that all happens if you understand this one concept called REP, which is real estate professional status. If you don't know about it, Google it, ask your CPA. A REP status allows you Before I tell you what superpower is, who qualifies and who doesn't qualify. In simple words, I can tell you is that if you have a W-2 job, I do not recommend to apply for rep status because IRS is pretty hard and they will audit you. But if you are, let's say, you are an active partner or a general partner in an apartment complex or in an asset, you let's say you're managing apartments or rental houses. Let's say you are a home builder. Let's say you are a realtor, right? You can qualify for real estate professional status. What is the superpower of that? So, for example, if you are a real estate professional, if you qualify as a rep status, remember that $80,000 of paper losses that we keep talking about. Now you can take that $80,000 and offset your other income. So, for example, if you are a real estate, if you qualify as a rep status and your spouse is a W-2, you invest $100,000, you have $80,000 of paper losses. Your spouse, let's assume your spouse is he's earning 100,000 and he's paying taxes on those 100,000. And most of the time, let's assume that tax bracket is 5 or 30%. So he's really paying, so you guys are paying $30,000 of tax at the end of the year. If you qualify as a rep status, you can take that 80,000, offset your income. Meaning your W-2 spouse who was making 100,000 after offsetting $80,000 of paper losses, now you're going to pay tax only on 20,000. The bracket goes down on 20,000 and your tax liability will probably be less than 5,000, right? So imagine that this is one strategy, took that paper losses, slash the tax bill from 30,000 to 5,000. That's what we were talking about early on. If we can do the right things in the right way and increase our income by not doing extra work, that's how we do it. But I don't want to make sure that we're understanding it correctly, right? There are repercussions. There are ways the IRS will ask you to recapture it when you sell the property. And that's exactly why we're here today, is to understand, okay, if that's the case, what is the right way to strategize? What is the right way to put things together? So from now, let's assume, right, not everybody will qualify for rep status. There are scenarios where, let's say, they are husband and wife and they're both spouse and they're not going to qualify for rep status. Well, let's see what happens from here. If you do not qualify as a rep status, then what happens, right? So let's take an example. Let's say you invested 100,000. Year one, you got $80,000 of paper losses because we did the cost segregation. We needed the bonus appreciation, meaning the operator that you're working with, the partner or the company that you're investing with, they know how to do it and they're doing it, right? And they can do it by hiring the right professionals. And they bring you that $80,000 of paper losses for your $100,000 investment year one. Year two, you get your tax reduced cash flow. That 8% preferred return is still your return with no taxes. Year three, let's say you refinance. Like we talked about, refinance is a tax-free. So now, stepping back, think about the $100,000 investment, the $80,000 paper losses. Third year comes in, you get $25,000 to $50,000 of refinance cash back, meaning that's somewhere around 25 to 50% of the ROI. Year four comes along, you still did there, you still get your preferred return. Year five, you sell. Usually, when we buy the property, we try to target that our equity should become at least 150%, maybe 175% to 200%. There are cases where we also not be able to get 150%. We got 140%. But as far as I'm concerned, it's a big ROI for me. And so if you remember this example, the $100,000 give you the refinances and the paper losses. Scenario number one, when both of the spouses are W-2, which is most of the case. Because you're both W-2, you cannot qualify for rep status. But you still, if you do your math, even if you have the paper losses, you cannot use it to offset your other income, but you can still carry it forward. And you can apply to other gains. Make sure that you know that there's a limit of $650,000. So if you and your spouse together making $650,000, or you cannot really apply that losses. Even if you can, your limit is $650,000. If this is too complicated for you, just know that these are things that CPA can explain you better. Cumulatively, you got your refinances, you got your capital appreciation return, you can still easily cross 300% just by investing in real estate and achieving those implementing those strategies. This is the case when they're both husband and wife are W-2 and they do not qualify as rep status. Let's look at the second step. Same example, investor 100,000. First year got the 80,000 of paper losses. Overall return is anywhere between 50 to 200%, meaning if you invest 100,000 after 5 years, you should be expecting to walk away about 150, 160,000, maybe 200,000. This is a scenario when one person is a W-2 and the other person is a home CF, right? Meaning he or she is a homemaker, stay home mom, stay home dad, taking care of kids, running household. That's a very common scenario where I've seen the other person who is not on W-2, their spouse, try to qualify as a rep status. There's several ways you can qualify for it. They're very easy. You can start your own business. You can be a realtor. You just have to explore a little bit more, but it's very easy to qualify for that, especially when you're not a W-2. That's the key, right? Once you qualify as a rep status, boom. In this example, let's say your household income is 200K. Remember, you were carrying over that paper losses of 80,000. Your net household income was 200K. You're supposed to pay taxes on 200K, but because your spouse qualifies as rep status, you're offsetting that 200K by 80K. Now you're going to pay tax only on 120,000. To make sure that we're reminding ourselves that this all was possible because you invested into commercial real estate, and that real estate was able to give you an accelerated depreciation. In other words, gave you the cost segregation of the bonus appreciation. If I want to remove all of these jargons in simple words, what you need to understand is, if you invest with the right operator and if they're doing it correctly, you can get the offset of your investment pretty significantly, and paper losses of your investment pretty significantly, and offset your household income. So imagine if you and your spouse, one W-2, the other one is a homemaker who converts into a rep status. Your net household income is 200K. You're paying taxes at 200K. But imagine every year, instead of accumulating 80,000 of paper losses, you find a way to do more investments and start accumulating 200,000 of paper losses. Well, guess what? If it's 200,000 paper losses, you will not going to pay any taxes. I want to go a little bit more, right? So now let's say year 3 comes in, you refinance the property and you pull out some cash from the investment. Let's say 20,000, 30,000, 50,000, whatever that number is. Well, remember, that's a tax-free event. So not only you did not pay the tax of the $200,000 of your household income, you also pull back some money, right? If all things combine, that can exceed way more than 300% of your return for that 100,000, because that 100,000 not only bringing you the preferred return of that investment, so 8%, 7%, 9%, whatever that may be. It brings you the paper losses, it saves you, it's offsetting your income to pay taxes, and the refinance. So if you do the math, and collectively speaking, it can cross easily 300%. Don't forget, there is a limit that applies. If your W-2 spouse is making more than 650,000, well, the offset maximum you can offset is about 620 or 625. I think there's a limit that IRS changes every year based on the inflation. I think 2025 years limit was 625 or 650, but that's a lot, right? So that's still, like, there are very few people who make that kind of W-2 income, meaning that up until that number, if you do it correctly and you manage your investments every year, you may be able to invest to pay no taxes. Now I want to go back. Somebody asked me a question, can you repeat on what happens with the both spouse W-2? Remember, both of the spouses who are W-2, they may not qualify for rep status, but their losses are carrying over. The year that you actually do qualify for rep status, or even if you don't qualify for rep status, let's say your two spouses are very happy with your W-2 and you do not want to ever do anything else. You love your job, right? Meaning, you still want those appreciation so that when you actually sell the property you can start offsetting other losses, other capital gains with your carryover losses. So it's still a very powerful strategy. It's just not going to offset your other income. Majority of the people not able to do it, but they still invest because when they invest, when the property matures, they're still taking the refinance cash out. When the property matures or sell, you still need those losses to offset the capital gains. I'm going to talk about it. Third case is if one person is a W-2 and the other person is a business owner. Well, that's a really good case, right? You still get your analyzed cash flow. You get your paper losses. That's in this example. Let's say your household taxable income is 500,000, right? Because one spouse is running a business, the income is a bit more. The other spouse is W-2. Well, if you only have the $80,000 of losses coming over, you're now paying taxes on 420. But that's where I want to emphasize how you want to strategize yourself. You should really be focusing or trying to get the whole $500,000 of paper losses, meaning doing enough investments to collect that kind of paper losses and apply to your W-2 income or to your household net taxable income. You still get your refinances. Again, limit applies. It's a $650,000 on W-2. And if everything combined, I can easily see that cumulative returns can exceed 20% very easily. Let's take an example of this case scenario. Right? They're husband and wife. Let's say they're practice owners, business owners. You guys work in the same practice. They're both drawing some salary as an employee, but most of the income is coming from the business. Well, in this case, there are no limits. There is no W-2 limits. And I usually explain this as a holy grail. If both spouses are business owners and you have enough carry forward paper losses, meaning you have enough depreciation coming each year, there could be a point where you actually pay no taxes, zero taxes. And I've seen several examples like this, very close examples like this that they're utilizing this. So now we understand these depreciations and how they're going to help with the tax-free returns on those investments, but also the offsets. But really, I want to point out, why is it not enough to just do one investment and assume that, you're not going to pay taxes? What you really want to think about is strategize yourself for next 10, 10, 15 years, or even 20, 25 years. Meaning every year, your goal should be to invest in these assets where every year it gives you some kind of depreciation. First year, you did 2 investments. Second year, you did 3 investments. Third year, you did 2 investments again. Fourth year, you did 5 investments. Now you see you have these 5 conveyor belts that you started your investment, and it's gonna fall off, meaning it's gonna sell every 3 to 5 years. So year 6, 7, 8, 9, 10, when your first year, second year, and third year investments are selling, you still have enough depreciation coming from year 3 to 7, right? And those capital gains from the original sales the new depreciation will offset. So you're still selling, collecting the capital gain, not paying as much taxes. All right. So this is the way I call it a multiple strategy. If you do it the right way and if you do it consistently, it avoids all the W-2 people who are trying to go into tax complications and trying to save some tax dollars here and there. It takes care of all of that. If you're a business person, those depreciations are so big that you don't even have to do too much. I mean, if you're running a business, we all know you have to do different things to smarten up your tax strategy, right? I've seen business owners paying huge amount of professionals to manage their own pension plan, create their own retirement plans, qualify for risky business expenses. All of those things will ease up. I'm not saying that you will not do it, but it will all ease up when you have real estate depreciation taking care of your other income. How do we supercharge? So far, the scenario that we've just discussed, as you get your depreciation, you may be able to qualify as a rep status. In between, you get your paper losses. But the question is now, is there a way to increase that paper? So for your 100,000 investment, getting $80,000 of paper loss carryover, is there a way to get 200,000 of losses for the same $100,000 investment. The answer is yes. There are some risks involved, right? Make sure you're managing your risk. One of the ways to do it is to become an active partner with your operator, right? Find a partner who are doing this, and you can become a general partner with them. So the general partner, your share will be higher, and you will get a higher paper loss. Right? So for 100,000 investment, you may be able to get $200,000 of, or maybe more of paper losses. Or you can buy one big investment. Maybe go buy one of the commercial real estate that you love, and you feel like you want to buy it and buy it all on your own. That could be one way. Or what I would only say is to manage your risk. I've seen people just for the depreciation try to go buy, overpay for smaller assets, and that happens all the time. Uh, Especially the case of Starbucks and Chick-fil-A and these kind of commercial assets. We don't deal with it. We deal with apartment complexes. We deal with small medical commercial real estate. But I've seen Starbucks of these kind of triple net assets. People overpay all the time just to accumulate some appreciation, and that's not a bad strategy. I'm just saying, be careful to not to overpay, because the moment you buy one asset by overpaying it, soon enough you will have to sell it 3 to 5 years, 7 years, and when you sell it, you will have the capital gain. To offset that capital gain, you will have to go buy something else, and that's what's called 1031 vicious cycle. You will have to keep buying and changing it so that you can continue deferring your tax. It's a great strategy. It works, but just know that it requires some extreme discipline and market knowledge and expertise and people to do that. So that being said, I mean, that's pretty much the last point I want to make. What are the asset types that can really help? I've heard people talking about single family rental houses. As far as the depreciation, the tax efficiency is concerned, or from the cash flow perspective, it's low impact. I will not recommend it. Short-term rental, it's mid impact. The problem with the short-term rental house is that you literally have to buy houses every single time, every year. And if you don't have time for that, you're going to hire a third party or work with somebody else, and you're basically depending on them, right? So it's a mid impact, in my opinion. It can be a high impact, but it's a huge time commitment. To me, it's not sustainable, right? Let's talk about land investment. It's no impact, cannot depreciate in most cases unless and until you have some structure. If it's a flat dirt land, it appreciates in the value, it doesn't appreciate. Offshore investment. I've seen a lot of people who want to buy assets or house or condos in their home country. There's no impact on tax if you buy something outside the United States. And just not that, I highly advise my friends and family to only invest in the sister economies. Meaning, if you're living in the United States, you want to invest in Canada. You may want to invest in Europe, where your transfer of your transfer of funds are not problematic. Your conversion rate is not problematic, right? I've seen people investing in India, and by the time 3-4 years later, the currency exchange rates have gone so high that they can, that investment doesn't make sense anymore. So similarly, what we like, or in our experience, the big commercial real estate has the most impact. It could be multifamily, apartment complexes, medical real estate, and things of that nature, right? So no matter which angle, which asset type you touch, it's your job to find the experience out here. Just simply do not go with the first guy you find. Do your due diligence, do your homework, know, like, interest, have the relationship, and then invest your money. These are things that we do. But like I said, this is not a sales pitch, so I'm just going to keep it super short here, and we'll open up Q&A. If you guys have any questions, there's a Q&A box that you can type. So we deal with primarily in apartment complexes, like I said, in commercial and in medical real estate, and we also have an income fund. That income fund does not bring you depreciation, but it gives you 8% return consistently. And the beauty of income fund is that you can liquidate your funds within 90 days. If you want to join our private investment club, please do so. This is our QR code. If you're on phone, take a screenshot. You can scan this, go to our website, and join us, and you'll get, anytime when we have a new deal, a new investment, you'll be the first one to look at. If you're interested in our income fund, like I said, this is a highly liquid fund that people invest in, and you can liquidate it within 90 days. So any questions? If you want the slide, feel free to text us. Take a screenshot. Number is 281-559-7061. Again, it's 281-559-7061. Our website is headwayinvestment.com. You can always email us, investor@headwaycapital.us. That will give Farah, can you please start, see if there's any questions that you can ask?
Yes, everyone feel free to put your questions in the Q&A. I did get some questions in my chat. I think they're very specific to you, particularly, Sid. So how do you help your investor with these kind of investments?
Yeah, so I think we talked about it, right? So we bring 1 to 2 projects, 3 projects a year. We liquidate 1 to 2 projects a year. Apartment complexes is the most favorite investment that comes into. That's in my opinion is the best fit from one angle, right? The returns, the depreciation, bonus appreciation, and the appreciation when we refinance the stock. So that's how we do. Second
Okay,
question.
and then there's a question about what is the frequency of these investments? I believe, how often are you bringing them in?
Yeah, I think we answered that. So it's between 2 to 3 a year, sometimes more, but we try to stay very focused and particular about what we buy, who we buy, how we're buying it. It's a safari. It takes time. I always tell my teams, like, you can buy anything if you won't pay. And that's what it is.
And then what is income fund exactly?
Income fund, yes. So income fund is basically the money actually goes into real estate. But the way it's designed, that it's for investors who may want the funds early on, meaning they don't want to lock their money for 3-5 years, right? Other investments like apartments and other investments, those are locked for minimum 3 years, maximum 7 years, sometimes 10 years as well. But we try to keep the investment between 3 to 5 years horizon. As far as income fund is concerned, that is highly liquid. You can invest, and if you feel like you want to pull back or do something else, you can give us a notice in 90 days, you can take it back.
Okay. I see a question in the Q&A by Larry. Is the depreciation denoted on the K?
Yes. So the K1 basically is a document that tells you what is the negative number that you're taking as a paper loss. So yes, that's right. I'm assuming that this is what you're asking, but that's what it is.
Great. And then where are your apartments located?
We mostly own in Texas and Arizona. Houston particularly, we are based out of Houston, so we're vertically integrated, meaning we manage and do our asset management and property management. But location-wise, it's Texas and Arizona, Phoenix.
Okay, and I believe there are a bunch of questions about how do we reach you. I think this barcode is the best way to just scan it, and that's our email, website. We'll
Yes, on
send
the
you something.
screen, if you guys are driving, you can take a screenshot.
Perfect. I think that's the time check, Sid.
Awesome. Thank you. Thanks everybody for your time. We truly appreciate that. I know it's middle of December. Holiday festivities are on the way, and taking time at 6 p.m. Central is a big deal. And that's why we take it very seriously, and we try to add value, sharing what we know. Hopefully, we'll see you next month. Thank you.
Thank you.